This is a Forex blog for August 20th, 2014. Just a quick video showing you how to use our software to the best to maximize your profitability. Before I show you our currency indexes, which make picking the best currencies to buy and sell easy, let me just show how our signals did today. Here's the euro dollar. Last night it sold here. That's what your risk is. And these are our old stops. The new stops are actually better. The new stops would have got you out of this trade here with a significantly bigger win. Then you go short again right here. Nice little small win, but 1.5 to 2 times bigger than what the risk is. And again, here, a bigger win than what the risk is. And that's the key to trading. I'll just showcase the new stop methods I'm working on that I hope to release in the next 2 weeks. Let me uncheck this so it uses my new stops. And you should see, like I predicted would happen on this trade here, instead of getting out with this trade right here, it got you out down here. Because most profitable trades, I want to have a little wider stop in the beginning. Once there's a 2-bar pullback, in other words, if we're short 2 bars up that are green in a row, then I start tightening the stop. Until then, I have a wider stop. And so it frequently does catch, like you can see here, the first trade generated a very tiny win. With the new stop, it generated 4 times more profit. And you know, in some instances we get out of this trade here, it might have got out of the old one, you know, maybe a pip or 2 more. But I'd rather catch those frequent, you know, extra 10 to 30 pip moves and give back 1 or 2 pips on, you know, some trades, just because it's higher probability. Let me just showcase how the pound did, and then quickly go over the currency indexes. The pound did exceptionally well today. Last night we sold here, small risk. You can see it pretty much broke even. Small risk, huge win. We made 10, 20, 30, 40, 45 to 50 pips on that. Shorted the absolute high, and then, you know, rode that down for 3 to 4 times more profit than what the risk is. And again, that's the key to trading. If you are making 4 to 10 times more profit on winning trades than what your losers are, then you can be right 20 to 30% of the time and still make money. And that's the real key to trading. That's what I focus on with this. High probability trades that are, you know, way more than 50% likely to work, but also to give you 1.5 to 2 times or even more what your risk is. Look at this one here. Risk versus reward. And as you can see, the rewards are significantly bigger than what the risk is. And it does a pretty good job of picking the highs. Notice the high here, and it picked the absolute low down here. Also knew that the previous downtrend was likely to reverse, you know, because the statistical tools that we measure all the pound pairs, the pound was getting stronger and the dollar was getting weaker, so we bought this little pullback right here, and you know, it happened to coincide obviously with a news report that went in the direction of the short-term trend, and we're already in, you know, 20-30 minutes, or actually 3:42. We're in 45 minutes earlier, and it just exploded up in our favor. Now the currency indexes basically let you see as a chart what each currency is doing. It's kind of like the S&P 500 for all the biggest stocks in the world, the Dow Jones 30, NASDAQ, Russell indexes all look at certain stocks, and they show you one chart that shows you what all those stocks are doing. This does the same thing for the dollar, the euro, the pound, the yen. And you can just quickly and immediately see the yen tried to get above its hourly moving average, couldn't. Came down and hit the lower bands, which typically is where it will stall and either go sideways or reverse. In this case, it kind of bounced, went down, came up again, couldn't take this high out. Pretty high probability place to be selling right here at 8:30. It's a weak currency. The daily trend's down, the weekly trend's down, the monthly trend unfortunately is up. But you know, when you're short-term trading just for the next couple hours, the daily trend, the weekly trend is enough to use. And you can see our perfect oscillator was at a high level here. And when the trend's down, every time you see that at a you know, at a high level, you can look for sells, and you can see sell here and here. And you basically want to sell the yen against the currency that happens to be strong at that time. So let's take a look at this currency. The dollar's been strong all day. It's pulled back near the hourly. So it's likely to go up. The yen's likely to go down. Let's just bring up a dollar yen chart at 8:30, 8:45. This is likely to go up. And as you can see, it does. It doesn't explode up at that time, but 8:30, you're looking for a buy. You can see a nice little pullback right here. You can see the low to the high. The 62% retracement would be right around there. I'll just draw it on the chart so you don't have to take my word for it. It went slightly below the 62% retracement. And this is one of those things where you can get into this trade with a small risk, and it kind of goes up, pulls back, goes up, goes sideways. You're going to probably get out of this trade. But the dollar's strong, the yen's weak. You might buy again here. Small risk, kind of goes up and goes sideways. I would have probably got out of this trade with a small profit, nothing huge, but bigger than what my risk is. And then it's just kind of going sideways for a couple hours. This is a rectangle pattern formation that we kind of have always taught in our classes in the past. And obviously it's probably a news release here that caused us to explode up. Let's take a look at another. I don't really follow the news that much, and I'm pretty much only working on our automated systems. So at 2 o'clock, it's obviously very likely a Fed announcement. But let's try to find another currency that is weak, like the New Zealand. Right? The dollar was strong. Remember at 8. This one's likely to go down, and it doesn't always happen that way. But you can look for a sell in the New Zealand dollar at 8. Now you can see on that New Zealand index it didn't really go down, but at 8:30 here we're looking for a sell. The risk is above here. It goes down a little bit. You might move your stop a little bit closer, and you would have lost on that trade, but not lost that much. And that's the key. Using the currency indexes, you can avoid a lot of unnecessary losses. And you can also analyze swings. For instance, the Swiss. Here's the high. It went up here, came down, tried to go higher, came down, tried to go higher, right? Couldn't get, it had 3 times to go through the high. This low broke this low slightly, and this low definitely broke this low, as you can see. And so when it pulled back up, very high probability place to be looking for a sell in the Swiss. Alright, so this is around 5:30 or 6 right here. Let's scroll this chart back so we can find some currencies that are maybe likely to go up. The Australian longer term trend is up. It's just kind of hovering underneath its hourly. The New Zealand looks like it could be at support here, but the daily, weekly, monthly trend's down, so I wouldn't waste my time on that. The dollar's just kind of sitting sideways up here. It's been going up, and this low is pretty much slightly higher than this low. It could very well shoot up. The daily, weekly, monthly trend is up, right? So looking for a dollar Swiss sell at 5:30 would very likely make you money. And if it doesn't, you're going to lose a very tiny amount. And if you're right, hold on, let me bring this up again. 5:30, we're looking for the dollar Swiss to go up. And guess what? It's kind of going sideways here. You buy that breakout, your risk is underneath here, and it did go up. Not much, only 10 pips, but your risk is maybe 6 or 7, so you still made more than what your risk is. When you see a strong dollar and a weak Swiss, you can you can always scalp it on a tick chart, or you can go to a 5-hour range chart, which I think always gives you a little bit clearer picture. You can have a tighter defined risk. You can, for instance, you see a multiple hour up down thing like this, you buy the breakout of here, put your stop underneath here. So this was your risk, and you can see again when it did go up, it went up 1.5 times more than what your risk is. And a lot of times with my range charts and my signals, I'm looking for 3 to 5 bar pullbacks. So when you see a higher high and you get a 3-bar pullback, especially with one with a wick that closes up, you can go long right here with your stop underneath here. And it's not the biggest trade in the world, but again, the potential profit is bigger than the risk, and ultimately that's all that trading is. If you have small losses and bigger wins and are right more than you are wrong, or if you employ advanced money management that a lot of professional traders I know do, and I do, if you have a couple trades in a row, you bet bigger, or if you can also bet 20% bigger on each trade. So let's say you do one lot in the first trade, you lose, you do 1.2 lots in the next trade, and if you lose again, you do 4 or 1.5 lots. So you catch one of these 10 or 20 pip wins, and you have more lots than your previous ones are. You wipe all those losses clean, and you're usually left with profit at the end. And then you start back over with your original smaller lot. I mean, trading is very easy when you use our methods, support resistance, Fibonacci's, and advanced money management techniques, which unfortunately I can't teach because in the hands of let's, for lack of a better term, idiots, they could wipe their accounts out very easily.